Hello and welcome to Subscribers Helpline, where our analysts answer some of the commonly asked questions of our users. Today we have with us Sneha to answer your queries. Welcome, Sneha.
Thank you.
So let's take the first question, sent in by Jayant Machingal. He says, as for retirement, regular stream of income purpose from mutual funds, I would like to know the difference between IDCW and SWP. So could you advise which one is going to be better?
Talking about which one would be a better choice, so starting an SWP, which is a systematic withdrawal plan from a mutual fund, would be a better choice versus an IDCW, which actually means a dividend plan, whenever we are talking about, deriving regular income from a mutual fund. Let's understand what IDCW means. It stands for Income Distribution Cum Withdrawal Plan, which actually means dividend. So what happens is that a mutual fund gives back the distributable surplus to an investor, which is at a pre-stated periodicity, and it is based on the performance of that particular fund. So it can be irregular too. Plus it is not at your discretion since AMC decides the frequency of it. Usually for equity and hybrid funds, they usually provide an annual dividend. Additionally, the taxation is what is at play here. Dividends gets added to your taxable income and are taxed at your slab rate. Now, relative to this, an SWP is basically a standing instruction that you are making to the AMC to give out a specific portion based on your withdrawal needs from the fund that you are investing in. So, you can effectively think which would be better, where you have the control and not the AMC, because after all it's your retirement needs, right? And regarding the taxation part of SWP, the gain component gets taxed here, and it only gets taxed whenever you withdraw, right? Until then nothing really happens. Plus the tax rate is also lower relative to the dividend plan, which is taxed at your marginal tax slab.
Alright, hope Jayant that answers your query. Now Sneha, the next question is Parag, Parekh, FlexiCap still investing in the US markets?
Right, so the answer would be a yes and a no here. No, because RBI had actually in January 2022 put restrictions on investing in overseas stocks. So that would be a no for the fund, which usually invests in overseas stocks. But a yes, because the older investments in which it was invested before the restrictions came in still remain part of the portfolio. But what has happened is that meanwhile the fund has seen significant surge in its asset size from somewhere around 20,000 crore of AUM in Jan 22. It now stands at around 55,000. So it has been continuously getting fresh money, but it is not able to invest that fresh money in foreign stocks and is just restricted to investing that in domestic stocks. As a result, the overall percentage of foreign stocks in its portfolio currently stands at 15%.
All right. So now Jayant has sent another question, and he asks, are ICICI Prudential Value Discovery Fund and SBI Contra Fund following similar strategies, value type investing? Can we have both in my portfolio for long-term investment? Will it be a duplication?
Okay, so first of all, talking about what ICICI Value Discovery actually does, it looks for stocks which have a relatively lower valuation as reflected in their price to earning ratio versus the market. Those would be the value stocks, and it is specifically looking out for those. Whereas SBI, that takes a contrarian approach, the name Contra, because of that. It actually focuses on funds which are out of favor, but they are not necessarily value stocks. They can be growth stocks as well. So that's where the distinction comes in. Now, at Value Research, we have a wonderful tool at your disposal, which is the Fund Compare tool. Let's just use it to compare the two funds. So you can find the Fund Compare tool along with all of the tools listed on the website. The tool actually lets you compare up to 5 funds, but we'll be doing that for these two, the Contra and iPro Value Discovery. One can notice at one glance there are of certain basic details that are being pulled out for you. Both SBI Contra and ICICI Value Discovery are part of the value oriented category. Both are 5-star rated by Value Research. Both have decent investor interest as reflected in their asset size. So look at the trailing returns reveal there have been times when one fund has done better and vice versa. The tool also helps you look at the sector distribution of the current portfolio, wherein you can see the iPro Value Discovery seems to have a higher exposure to financial sector versus SBI Contra. Under the holding tabs, one can find how much concentration both the portfolios have in their portfolio. When you look at the number of stocks, both seem to be pretty diversified, and it seems like pretty competent fund management has been managing both the funds. Another aspect that we should be looking at are the rolling returns, since it helps us evaluate how the funds have done across market cycles. Both have managed to beat the benchmark decently, and sometimes one has had an upper hand, sometimes the other. Overall, both seem to have good performance history, and interestingly, both seem competent enough. And more importantly, over longer time periods, one can't really guess which will do better over the other.
All right, now the next question that we have is, could you please advise on PMS? I'm aware that it is for HNIs and minimum investment is 50 lakh rupees. However, will this benefit over mutual fund for a period of about 5 to 7 years is what the user wants to know.
So we believe mutual funds are a superior option over PMS, and there are some tangible as well as intangible advantages that mutual funds have. One being regarding the cost. So usually PMS comes across as more expensive than mutual funds. Secondly, their design is what kicks in the basic difference. So PMS are actually sold on the premise of customizing investing needs focused on one particular individual, whereas mutual funds by design we all know is a pool of public money, so they have better regulatory requirements that they have to adhere to, and therefore they come under higher scrutiny. Another important aspect is the economies of scale. So with a 100 rupee or a to 5,000 rupee, I guess that would be the limit, that you can actually start investing in a mutual fund. Further, the beauty of being able to spread your investments over a period of time is what mutual funds offer. Now, of course, one cannot do that with a 50 lakh entry level ticket in a PMS, right? So, and by spreading your investment, you're actually able to manage your mind when the market actually goes through a turmoil kind of a phase. It actually helps you manage that volatility that, market inherits.
Yeah.
So those are the benefits. Another important point is that the transparency or the regulatory requirement that I was talking about. So one of the disclosure is that at 11, all of the mutual funds have to come out with their NAV, which is the net asset value, the price of the fund. Now, PMS, of course, by design, since it's for one particular individual, they are not required to produce that in public. Now, lastly, when a portfolio management is managing your PMS, a lot of trading is happening in your demat account. So you are actually bearing those transaction costs, plus the taxability factor of it, the short-term capital gain, the long-term capital gain. But you will be bearing those costs, right, while the PMS would be managing your portfolio. So it's like the short-term capital gain actually becomes like an annual tax liability for the individual investor. While in case of mutual funds, you'll only be taxed when you redeem. So, that's the difference. And more importantly, you can convert your short-term capital gain into long-term capital gain just by increasing your holding period.
All right, now Moksha Kotaria has sent the next question, and he says, I have received around 10 lakh rupees after my PPF matured. I don't need the funds for 10 years, but I have a home loan to close off in next 7 years. So, do I repay the home loan first or invest the funds in diversified equity mutual funds for 10 years? If so, please suggest some funds as well.
Okay, so value research users, will be aware of the fact that we've always urged people not to go for borrowing. But home loan being one justifiable borrowing, provided it is done to
if you want to live in that.
Exactly, so that it helps you avoid that rental outflow.
Right.
Additionally, it gets you that tax exemption as well. So I would say to not prepay the home loan and maybe use that surplus to invest. And investing can be done maybe in a few diversified flexi cap funds. And if there is a higher risk appetite, the user is pretty aggressive, a small allocation to mid and small cap funds would also be beneficial over
Since he has 10 years.
10-year period. Exactly, that long term really helps to actually be aggressive with your investments. Also, our calculations have shown that investing in these funds, the surplus in these funds, can potentially get you a higher return versus the interest rate of the home loan that the user has. However, the biggest caution here is if having that home loan actually acts as a burden and doesn't really let you sleep. So one should totally get rid of it, because money is there to help you sleep better, and it is not something to lose your sleep for.
Right. Hope, Moksha, that solves your query. Now, Bhupendra Kumar has sent in the next question, and he asks, when investing in a FOF fund like Navi Nasdaq 100 FOF, is it possible to see my holdings of each of the equity investments of that index? I want to be able to see the list of stocks and my current holdings similar to any other fund in premiums.
So the details of the funds which are not part of the Indian fund universe are not available on the Value Research website. So for instance, you can find the data for Motilal Oswal Nasdaq 100 FOF, which actually invests in Motilal Oswal Nasdaq 100 ETF. Let me just pull up that particular fund page for you. So if you go to the portfolio holdings, there'll be a hyperlink to Motilal Oswal Nasdaq 100 ETF, which once you click, you'll move on to the portfolio of that particular ETF, which actually provides you the entire list of the top holdings. But for that Navi Nasdaq 100 fund that the user is talking about, that data is not available on Value Research yet, but we'll try to incorporate that.
So Sneha, with that, we've reached the end of this session, but we'll continue to take your queries, so do keep sending them in and keep watching. Thanks.